I'll speak very slowly so people can get their seats back. We continue with two panels that are devoted to different dimensions of governing after zero. One, a view from the private sector, and then another one, a view from the public sector. As David Wessel noted, there are so many different dimensions to the current period of unconventional, or in this case, truly extraordinary monetary policy, that our hope was to bring together people from different environments who rarely, if ever, get an opportunity to speak to one another and then to speak to the public. We try to bring together people who from the policymaking community, people from academia, and people from the private sector, and this panel is a great example of what we intend to do. So this first panel, Governing After Zero, the view from the private sector, is moderated by Binyamin Applebaum from the New York Times. Our panelists, and again, their bios are, their lengthy bios are in our program, so you can consult that if you like. But our panelists are Charles Goodhart from the LSE, Desmon Lachman from the American Enterprise Institute, and Shirley Lin, who is a senior advisor at Crestview Partners, used to be at Goldman Sachs, and is, I'll still treat her as a member of the University of Virginia family. Right, so, Binya.
Good afternoon. We're here to talk about the canvas on which monetary policy plays out, the private sector, and in particular the financial sector. They are the audience for monetary policy, the transmission mechanism, and ultimately the part of the economy most directly and immediately affected by the decisions taken by central bankers. And we have three panelists who are each going to talk a little bit about how that impact is likely to play out in the coming months as the Fed at least begins its transition away from this extraordinary period and back towards something that, if doesn't resemble what used to be called normal, will serve for normal going forward. And so without further ado, let's hear from them. Desmond, yeah, please.
Yeah. Well, thank you very much for inviting me, and I just give some reflections on where I think we're going at the end of quantitative easing in the United States, what the future might look like. And I would really emphasize, despite what David Wessel said about not overusing the word extraordinary, start by saying that the monetary policy that we've seen from the Fed has been extraordinary by any standard. We've never seen interest rates held at these levels for as long as they were held there. We haven't seen the balance sheet of the Federal Reserve, instead of looking at it going from 800 billion to 4.25 trillion, you might think of it that the Fed has now got a balance sheet that's equivalent to around about 25% of GDP. So we really are in totally uncharted territory, and it's not easy to predict how this is going to break out. I say that as well, not simply because the Fed has behaved in an extraordinary way, but because the global economy right now displays a number of extraordinary features, which I'll get to in a moment. So the first thing I'd say is when you look at where we might be going with quantitative easing, the exit normalization, what you should start with is the thought that, to use Milton Friedman's language, quantitative easing wasn't a free lunch. That while quantitative easing might have done some benefit for the United States economy, particularly at a time that fiscal policy was restrictive, through lowering interest rates, through increasing asset prices, the way in which it did, it prevented the US economy going into a depression, prevented deflation. All of that is well and good, but it came at a price. And the price is it's caused bubbles in a whole series of markets. I'm not just referring to the equity market. I'm a lot more concerned about the United States credit markets, that the amount of leverage that is in the system, that we've now got mispricing. And when one normalizes interest rates, when the liquidity dries up, we've been through this dance a number of times, and it generally isn't pretty. So that is the one cost that we're likely to pay. Another cost, in a similar vein, is what quantitative easing has done to the emerging markets, that the emerging markets, when quantitative easing began, they were hit by a flood of capital that they couldn't, capital went from the United States and the rest of the developed world into the emerging markets, pushing up their currencies, causing excesses of a variety of ways. So now we have many companies in emerging market land who've borrowed in dollars. So when the dollar begins to appreciate, we're going to see a lot of distress in places like Brazil or India, Russia, so on. So that's the first point I want to make, is that the quantitative easing wasn't a free lunch. The second point I make is that as the United States is normalizing its interest rate policy, and so I say beginning to talk about normalizing its interest rate policy and ending quantitative easing, what we've got is we've got two major central banks going in exactly the opposite direction. The first is the Bank of Japan. They are engaging in quantitative easing in a way that makes that in the United States look pale. If the United States has, the Federal Reserve's got assets on its balance sheet now equivalent to 25% of GDP. Japan is already at something like 50% of GDP, and they're only starting. They're pushing this up. The ECB, it's only a matter of time before Draghi gives some concreteness to his intention of increasing his balance sheet by $1 trillion. What all of this means is that we've got monetary policy now totally out of sync between major countries, and you'll see this in the exchange markets. So what you're seeing already is the Japanese yen, since Abenomics began about 18 months ago or so, Japanese yen has already moved by 40% against the dollar. We're now going to see the euro moving very much against the dollar. So what it means is that you're going to get an appreciation of the dollar. We've already seen an effective appreciation of the dollar of more than 10%, which causes complications going forward, in terms of balance of payments issues, but also in terms of inflation, which is another matter. The countries in Europe and Japan are exporting their deflation to the United States. The third thing I would say, what makes all of this episode of the United States getting out of monetary quantitative easing going to complicate matters, is what's happening in the oil market. We've already got tectonic changes in the oil market as a result of shale oil production, the slowing of the United States economy. So in the space of the last 3 months or so, we've had a mere collapse of oil prices by something like 40%. So what that does, in my view, is it's going to put the Fed in somewhat of a box, that if I take the oil price decline and I take the appreciation of the dollar, what it means is the United States in 12 months' time or so is going to register inflation that is round about zero, if not negative. You're already seeing this in the tips, the implicit inflation in the tips. So the Fed is going to be in a difficult situation, that the economy, labor markets will be tightening. All of their metrics that normally tell them the market is getting strong is going to be tightening, but on the other hand, inflation is going down, inflation expectations are going down, so it's not going to be that simple. The last point I'd make, which I can't resist making, is all of this is occurring against the backdrop right now of a little political drama playing out in Greece, where that was the start of the Eurozone crisis. I could bore you with the details, but the bottom line is that there's a very strong possibility that a radical left government is going to come into power as soon as January or February next year. The Greek stock market, the last 2 days, has dropped by 20%. Bond prices, 6%, are now up at 10%. That there's real crisis going out, that if the Greek situation does play out badly, and I would say that there's at least a 50% chance that it does, we might have another crisis in Europe early next year, which means that it's not a slam dunk. I'm not sure that I share the Fed's confidence that we're going to start reducing interest rates, we're going to start hiking interest rates, and we're going to go straightforward with this, because I think that there are many things that can go wrong, and I think it's really going to be a challenge for the Fed.
Charles?
There are always many things that can go wrong. That's one of the greatest joys of doing work in this area. It keeps you on your toes. But I always like sort of responding to other people, so I will respond a little bit to what's already been said. I'm going to start by responding to David's comments about the use of macro-pru, and saying that macro-pru involves targeting various people, particularly in the housing market. Now, the way that the Financial Policy Committee in the UK has handled this is to say that what we aim at are the banks. So we do not try and change loan-to-income ratios. What they say that they are doing is they're telling banks that they mustn't undertake mortgage loans more than X% for those mortgages where the loan-to-income ratio is greater than such and such. So the FPC says that the sector that they are focusing on is the banks, and that their argument is not that we're trying to influence the housing market. We're trying to ensure that the banks don't get into trouble if the housing market goes a bit queer. The second thing I would say, in slight response to Desmond, is that I think it's a mistake to think of quantitative easing as a single event. I think that QE1 was, in fact, magnificently successful. In the late winter and early spring of 2009, there really was panic all over in all our countries. Stock markets were collapsing. The risk spreads, credit spreads, term spreads, every spread that you could think of was rising very sharply, and there was an enormous shortage of liquidity. And QE1, as done in both the US and in the UK, actually met that need for liquidity. It turned the stock market round. It brought about a vast reduction in all those spreads, and I think that QE1 actually did, in some respects, save the world. QE2 and QE3 were far less effective. By that time, fears about panic, that the markets were collapsing, the financial system was in a meltdown, had gone. The spreads between long and short rates had been reduced very little. Long rates had already been reduced. The spreads were all very low. And it didn't really actually amount to very much. Yes, long rates came down a tiny bit more. And whereas in QE1, the sort of general consensus is that long rates came down by nearly 1%. With QE2 and QE3, it's difficult to see that long rates came down more than about 10 or 15 basis points, which is peanuts, and it really is. The main effect that QE2 and QE3 had was on the exchange rate, and that was far from being beneficial. In particular, given the level of wages, it meant that the real incomes of those countries which were doing QE, the real incomes of most people actually went down. One of the things that worries me is that there is somehow this belief that if Draghi can only start getting QE going in Europe, that somehow things will be miraculously better. I don't think they will. And talking about bubbles, I do really think that the world is safe when Italian and Spanish long-term interest rates are lower than US interest rates and UK interest rates. What we have seen is the largest ever world carry trade that has been financed by the ECB to push up sovereign debt prices in peripheral Europe. And that is, I think, it's a very dangerous situation. And I don't actually see that if Draghi does get QE going, that it will do very much. And I have my doubts about whether Abenomics will work. What's much more beneficial, of course, is a reduction in oil prices, because it's Japan and Europe, which are not oil-producing countries, which will benefit most. And again, one can't generalize about the effect of oil prices on the emerging markets. India is going to benefit really enormously, whereas, of course, Russia and Ecuador, Nigeria, Venezuela, and the oil-producing countries, and Australia, for that matter, are going to be very much damaged by this. Now, finally, The other thing that I would just like to put on the table, which is where I think Shirley will come in, is regulation. Regulation is almost always wildly pro-cyclical. You have a bust, the banks get into trouble and get weaker, and the regulators say, that must never ever happen again. And of course they're right. But to do that must never ever happen again means you're tightening up on a banking system which is already weak, so the banking system effectively can do less and less. So you get no credit expansion, and so the system remains weak. And then as you get out of it, people stop worrying so much about regulation and the pressures ease off, and effectively everyone eases under the continuing lobby of the banks until you get the next crisis. And then so that the whole process of it. And again, I entirely agree with David that it is highly desirable that the banking system should have a very much higher equity ratio than it did going into the crisis. And in fact, I think that the sort of Admati and Hellwig argument that it should be a multiple higher in equilibrium is in fact actually correct. And if you were to compare two banking systems, one of which had, say, a leverage ratio of 3, and the other of which had a leverage ratio of 3%, the other of which had one of 15%, the 15% one would be far superior. The problem is not so much the levels, it's a transitional problem of how do you get there. You've got a weak banking sector. You tell them they've got to have a very much higher equity ratio. The incentive for any bank CEO is to maximize the return on equity. So what are they going to do? How are they going to hit the higher ratio? They're going to do it by deleveraging. And we've had deleveraging, banks trying consciously to get smaller and smaller. We've also got a system, particularly in Europe, where every country, the politicians are effectively blackmailing their own banks. What they are saying, in effect, is we want you to have a very much higher equity ratio, we want you to have a very much more conservative leverage ratio, but we don't want you to cut back on lending at home. So cross-border lending has just collapsed. We no longer have, certainly in Europe, a single European financial system. It's fragmented, it's balkanized. Our global banking system is largely fragmented and balkanized because, again, the cross-border lending has been declining until this year, really very sharply indeed. And the whole process of regulation is the objectives. The incentives are great, and the ultimate objective is desirable. But my God, the transitional route has been bloody awful.
Well, on that note, I have great responsibility to expand on that. But for today's conference, I looked at the program and I thought, this is all very interesting, and my two esteemed panelists already sent me what they were going to speak about. So I looked at it and I thought, well, I could add more to the theoretical implication of the Fed changing policy direction, but I thought it'd probably be more interesting, since we're speaking about the private sector, for me to poll all the companies I work with. And so I wrote to 15 companies and funds, 5 of which I'm actively involved with right now. And I said, look at this program and tell me what you think. It was so surprising that the response was consistent and emphatic in what they wanted to talk about. And every single one of the company in the fund said, you should highlight the asset bubble. So I thought I would expand on this part as well as the regulatory implication for the financial industry of what has happened since the last asset bubble and what the government has been trying to do. I think the QE program, of course, has helped the US economy recover to a large extent, well, relative to other markets. The policy has created incredible challenges, however, for the private sector. And this has been in uncharted territory, as both of my panelists have said. Since the crisis ended 5 years ago, the US economy has been expanding the money supply, and during this time, equity markets have rallied to the point that today, as you all know, the forward PE is 16 times, and we are at a very high level. I would say, depending on the statistics you look at, it's about 70 to 80% of historical average. Now, what does this mean for the private companies? First, I think there are 3 points I want to make First is that it has been incredibly difficult to generate returns on absolute and relative level, and incredibly costly to hedge. Now, we've been talking about how important is it to learn from the last crisis. The last crisis, we learned that many of the financial institutions did not hedge properly. But in today, volatility has become sporadic and difficult to calculate, and therefore hedging costs has increased tremendously. So most of the funds are unable to hedge on a cost-effective basis, and return has been basically zero. And most of the funds are not able to keep any of their money in cash because that's unacceptable. So the drive to continue to play in this casino is very strong, the pressure to play, to invest. Even with the most opportunistic funds I talk to, the one that I'm most engaged with, Crestview Partners, they are both buyers and sellers. And this year they sold 50% of their portfolio. However, even given that, they said the environment is very difficult. Even if you're a seller, you need to continue to invest and also help your companies deleverage. Now, the problem is, of course, you benefit from making accretive acquisitions. However, the cost of making further investments is very high because all the assets are very expensive. Now, this is all sort of surrounding the US environment. The cost, on the cost side, in addition to hedging, as we all know, the compliance cost has increased tremendously. And I was just telling Jean that on Monday I spoke with two of our friends, former Secretary Paulson and Rubin. Were speaking on Monday to a group of us about basically the regulatory environment continue to be stricter and how necessary that is. However, we all know a lot of it is driven by a Congress that doesn't really understand the financial industry. So while the cost has increased and compliance is needed, a lot of it is just adding to the cost in an environment where the companies are not able to generate the returns that were expected in the past. Now, for most of the funds I work with that have 20, 30 companies in their portfolio, a healthy return is usually generated when inflation is 2 to 3%, and the long-term rate is about 5%. And we've been under those targets for more than 4.5 years now. And so what that means is the challenges are tremendous. I want to move on to add to the compliance cost. I've been involved with Goldman Sachs setting up a bank in Hong Kong for the last 2 years. It's taken 2 years and so much cost because both the US Fed and the Hong Kong Monetary Authority need to approve of the bank. And we've had more lawyers on this project than I've ever seen in my 25 years in the business. And of course, most of the profit is going to be going to the compliance department and not to anybody else. But I think it's necessary. It's just how to do so is a question that I don't have any answers to. I want to move to the third point, which is about basically how does this hit international private sector actors. Well, internationally, everyone is in a tight spot. And I've just spoken to several of you during the break who are in real estate. I sit on the board of Langham Hospitality, which owns hotels around the world. 2 years ago, we were asked to bid on every single project in the US and in Europe, especially in England. Since about a year ago, nobody asks us to bid anymore. We have to go fight. And the last 5 projects, this is a public company, and in the last year, every single project we've lost to, the success bid was 50% above the reserve price. 50%, it's really unprecedented because there's so much money around from the last 5 years of the QE program in the US, and with Japan and Europe joining the fray, we are seeing so many funds, sovereign funds, Chinese funds. So the last 5 bids, if I could elaborate, one was lost to the largest Chinese commercial company, real estate company, to 2 UK hotel funds, and to 2 US real estate funds. These are hotels around the world, but what's coming up next is Japan will be the next battle, and prices will definitely be increasing there. And Japan is a market that I personally am very involved with right now. While the Japanese economy has not recovered, asset prices will go through the roof with the program that is in place. So what does this all mean? I think the important thing to remember is that China is a unique and separate issue, but it has exacerbated to all these problems. How? I wasn't going to speak about this, but in the last session, I realized I do need to address this, and this is actually my expertise in my area of research. But Japan, first of all, there's $4 trillion of reserves, and China needs to invest this US dollar reserve. And so if it is not coming back to the US, it has to find another way to invest it. So the Chinese government has had this problem for decades, and this global imbalance will only become more severe. And we will see this because with the new administration, Xi Jinping has to politically keep the GDP growth at 6 to 7% or above. Basically, below 7% is considered soft landing. Below 6% is unacceptable to the Chinese Communist Party. So how do we fix that? Well, we've all seen this. Actually, when David asked me to speak on this panel, I said, I can't speak on this panel, David. We don't have independent monetary policy in China. And we don't reduce interest rate. We don't join this kind of race. But of course, that is not true. As you all know, in the last few weeks, China has lowered its interest rate. But what does that really mean? I think first you need to keep in mind it will not be a consistent loosening monetary policy as in the other countries, because it is much more politically driven than economic fundamental driven. And so whenever there is some weakness in the economy, the government has to do something, and it has done so. But the result, of course, is unintended negative consequences. In the last few weeks, the A-share market, which is the domestic Shanghai market, has gone through the roof. There's no fundamental. It's weak. The economy is weak. Actually, the interest rate does not help private sector actors. The interest rate actually goes to state-owned enterprises and basically companies that are connected to the administration. So there's a very small group number of them, but they are important players, including the sovereign wealth fund. And so what China has really contributed to is three things. One is increased money supply in the world looking for investments, and this will continue unabated. Second is it's contributed to declining commodity prices because of weak demand in China. And when you talk about commodities, we're talking about oil and other commodities, many of which China is a net importer. And number three, I think what you will see in China is that it needs to keep renminbi it needs to continue to appreciate the renminbi. And every time it loosens the policy, the renminbi will depreciate. So there is this very difficult balance that the Chinese government is trying to maintain. And therefore, the net conclusion is, I agree with the speaker, that you will not be able to predict what will happen in China. And because of that, we need to, in the United States, be much more careful about relying on that as a net source of funds. So that's my one segue into China. And of course, China is dealing with its own asset bubble, both in housing as well as in all of its equity markets. And that's something that will continue to be worsened by the policies that are being driven by China. Now, I want to conclude by saying that do the private sector actors believe that the Fed is communicating properly on a timely basis, and do they see anything done to address this asset bubble? The short answer is no. In fact, the private sector actors, I think, are very concerned that the Fed is, not the Fed, the central banks around the world are not able to do very much because of exactly what the two other panelists have said. Declining commodity prices and strengthening US dollar in the United States, for example, means that the Fed cannot simply raise the rates in order to deflate the asset bubble, because there are other economic fundamentals that we need to deal with. And the economy is not recovering at the speed that we like. Unless inflation reaches a certain target, you cannot simply raise the rate in order to fix the asset problem. Around the world, we have similar issues. Most economies are weak. Japan is not recovering. Europe is not recovering despite these programs. And so can the central bankers really help take care of this problem? The final thought is that everybody said the same thing to me, which is this is a big casino, but we have to keep playing because keeping money in cash is not an option. However, the problem is this a bigger bubble? If it's a bigger bubble that is expanding, we need to keep playing and get out at the right time. So I said, isn't that just like 5 years ago? Have we learned anything? We have, but we still don't know what to do about it. So the second issue is, if we are not in an expanding bubble, if we are at the peak of a bubble, then what should we do? Well, for a private sector actor, you need to either exit or hedge. And neither of those two options are at a reasonable cost. Therefore, everybody, I think, is feeling, I think, the toughest spot they've been in more than 2 decades.
You've all painted a picture of a fragile and distorted marketplace in which the Fed needs to operate. I'm not going to let you get off as easily as saying that these are tough questions and we don't quite know how to answer them. give advice to the central bank. How should it proceed back to normalcy from where it stands right now? What is the way to answer the questions that you've raised? Please, you start. They're good questions.
I'm glad I prepared for that, but there was not enough time in my speech. I think for the world economy, what the U.S. has been doing has been extremely distorting. And one of the biggest issues for the United States and for around the world is with the U.S. dollar appreciating, everybody has to invest in the United States or hedge against the local currency for absolute returns. And that is very difficult. I think the central banks around the world, especially the United States, I think has to focus on how to adjust the asset bubble. I think if this is not done, we are repeating basically what happened during the global financial crisis. And there seems to be very little, because during the last crisis, if you remember, what was happening was exactly that. That the asset bubble was growing between 2002 and 2007. I was still very active on sort of direct investment side in China. Everyone knew clearly that it was an asset bubble, but nobody was ready to exit. And everyone was just hoping that I'm not the last one. And so if you look at the PE, forward PE now, it is the same. It is now higher than December 2007. So that is a very scary sign. And I think that, I really think that there could be giving out signals that would allow asset prices to come down is probably sufficient as a first step. Whereas I think very few people believe actually the Fed actually intends to do anything because of the economic situation.
Yeah, my answer would be that the horse has already bolted. You know, you're now trying to close the stable door long after the damage has occurred. And really, the original mistake was made, you know, with the housing bubble. You know, you get an enormous bubble that we had 2006, 2007. You know, when it bursts, you then obliged to go for broke. You know, there's nothing else. You're just looking into the abyss. So you open the spigots, and then you create yet another bubble. You know, so we're in. To me, it looks like we're in this sort of cycle where it's going to be very difficult to break it. I just should mention.
But how do we get out of that cycle? That's the question.
I think you're asking a question which is really profoundly difficult. That we've messed up in such a massive way, that the policies pursued, in the United States, with the Federal Reserve under Greenspan, we're already living in the aftermath of it. So perhaps, we should let this thing bust. We should let it correct, and take the pieces and then move on from there. And let's not try to make these mistakes before. But I think that we're in a really very difficult situation. And if I'm sitting in the central banks, I'd be doing pretty much the same. Charles says in Europe, QE isn't going to work. I probably agree with him. But what does he want them to do? They're facing deflation. They've got very high levels of debt. This whole euro can come apart. He's got no option but to. It's the only instrument he's got. So the alternative is to have a huge crisis. So I think that we're really in that kind of world where there's a dynamic, from the political point of view, from the central bank's point of view, that we're really lurching, from one big bubble and bust, to the next.
Charles, is it time to pop the bubble?
In Europe, thank God, the oil price reduction will keep the economies of Europe, and particularly the periphery, going quite happily this year. And the problems are political rather than economic. But actually, the situation is, in my view, quite simple. The central banks of both the US and the UK are going to be looking at the underlying core domestically generated inflation, which depends on labour markets. So what both the FOMC and the MPC will be looking at will be a whole series of labour market data unemployment rates, participation rates, wage rate growth, unit labor costs, productivity, the whole lot. It's quite complicated to put together, but you can put it together. And assuming that these continue to recover and recover pretty strongly, as it has been doing in both the US and the UK over the last sort of few quarters, they will totally ignore the figures for inflation rates, which they will claim, and with some justification, have been reduced by purely temporary effects of the oil, commodity prices, and the exchange rate. So I think my expectation is that the inflation rate will be going down at the same time as the Fed and the MPC puts interest rates up. And if the developments in the US go on at the same rate as they have in the fall, I would expect this probably by the end of the second quarter of 2015, because your domestically generated inflation conditions in your labor markets are beginning to recover pretty strongly. Yeah. And that's what the Fed has to do, is what the MPC has to do. It's all actually quite straightforward. Just stop looking at inflation, because temporarily it's going to be influenced by major external factors which have virtually nothing to do with longer term trends.
But I'm not sure that I think it's that straightforward, for the reasons I mentioned before, is that I think first what you're going to get is you're going to get huge exchange rate movements. We've already seen that. The dollar's already appreciated by 10% before the Europeans have started their bout of quantitative easing, before we've seen the full effect of the Japanese quantitative easing. So you're going to have a deflationary force from that side that is coming through. The second, if I take your logic, your argument to its logical conclusion on Europe, if quantitative easing is not going to work there, Europe is heading towards a breakup. That many of the countries in the periphery, you mentioned Italy. Italy's got a debt of 132% of GDP. And I agree with you totally that it's insane that Italians can borrow at a cheaper rate than the United States, particularly after Moody's graded them down to one level, one notch above trash, that Italy can borrow at 1.9%. So I think that the United States has to take into account that you could very well get an unraveling of the euro, that Europe is not a trivial sized economy. If that were to occur, we've got a different ball game as far as the United States. The last point I'd make is that the Fed, I'm not sure that I agree with the logic that they've got, but they attach, as does the European Central Bank, attaches a lot of importance to whether inflationary expectations are well anchored or not. My expectation is that if we do see oil prices bringing a big deflationary force, we see the effect of appreciation bringing a deflationary force in the United States, inflationary expectations will become unanchored. As I've mentioned, that if you look at the tips, you've already got inflation expectations the next couple of years is down to 0.3, 0.5%. The Fed and the Europeans think that this influences the way in which prices are set elsewhere. So I don't think that they can be totally insensitive to what is happening on the inflationary expectations. So I think that there are very many factors that I can see that can cause this game to be a lot more difficult, and I just don't buy that we're going to have a nice smooth raising of interest rates and these bubbles are all going to deflate in a nice way. That as soon as you pop the bubbles, you're then going to have another set of problems to deal with.
So I want to come back to inflation in a second, but let me ask you, Charles is essentially arguing that the United States and the UK should proceed in their own interest and focus on the underlying strength of the domestic economy and go ahead. To what extent should they care about the rest of the world? Make the case that that should be a consideration for U.S. monetary policy.
I'll come to that, and this is part of what I wanted to say to Charles. I think it makes sense what you said, Charles, about not looking at the inflation number. But one of the things that I think private sector actors are very confused about, and this is one of the questions that you have posed, Binyamin, in sort of, communication, whether the central bank is giving out the signal. I think what Desmond said, I agree with very much, which is the inflationary expectation has to be managed. And the fact is everyone is expecting very low inflation numbers. And so the Fed simply can't just, in order to deflate the asset bubble, consider one and not the other. And that's part of the communication and not having the actors be surprised. And sort of when a private actor is thinking about hedging costs the problem is hedging for the long term. That's what's difficult, not short term. Everyone hedges now weekly, monthly, because they don't know what's going to happen. And in order to hedge forward, you need to have inflation expectation, and that inflation expectation leads you to conclude whether the Fed will increase rates or not. And so all of this comes together to create this environment. And internationally, I will tell you, Binyamin, why it's very important for the United States to care about it. And I think that's one of the issues. When I join these kinds of discussions, usually there's very little discussion about China or the world, and simply because so many of them do not have independent monetary policies. But today's world, I'll give you an example. I've been on the board of the joint venture partner of MassMutual, the life insurer in Taiwan, and they basically have changed their investment policy last month to now to do only two things. And this is such a big change from what a lifer, as we call them, should be doing. They need to, of course, invest in order to match the liability they have to pay out for those policyholders. And what have they done? They have now divided their long-term portfolio to do only two things. One is to get a license to trade in China, to basically get involved in Chinese equities. Because if that's a bubble that you can benefit from, you have to be involved. And China has, of course, moral hazard. Everything you buy in China, if it's a state-owned enterprise, it will never go down. It will never go bust. And therefore, you buy junk bonds in the United States. Now the spread has dropped by 1,000 basis points. So that's not viable. You can only buy corporate bonds in the United States. So that's the other thing they do. They buy corporate bonds in the United States because you have to be in dollar. And then you buy something that's in renminbi. And if you divide the portfolio that way, so what does that mean? The whole world is coming to the United States to invest. All the money will continue to come here. This is the only economy that is, for a insurance company, for example, that is very conservative and prudent. It is the only economy that you can really park your money safely, at least to a fixed percentage point. If you can imagine a small insurance company in Taiwan thinking this way, everybody else has their portfolio, part of it is in the United States. And so I think the United States, when it thinks about its monetary policy, it cannot be disengaged from the rest of the world, on top of the fact that the Chinese government is a primary investor.
A decade ago, central bankers were sure that the primary, perhaps the only responsibility of a competent central bank was to hit an inflation target. That ought to be the central focus. And today we hear all of you talking about discarding the inflation target and focusing on financial stability. It's a remarkable transformation, and I don't doubt that financial stability ought to be a more important consideration. Surely we've learned that along the way. But it is striking to me that all three of you are turning away from that question of, are we hitting an inflation target? And Desmond, I'll start with you because, in your remarks you said, that it's complicated if inflation is at zero. Why is that complicated? Why doesn't the Fed just have an absolute obligation to get back to 2% at that point?
Well, for a start, the Fed's got a dual mandate that, you must distinguish the Fed from the ECB. The ECB's mandate is they've got to get inflation at close to but below 2%. The Fed has to worry about employment and stuff of that sort. I would think that a mistake that the Fed's made in the past is that they've been fixated on price inflation, but they've turned a blind eye to asset price inflation. That was the story in the keeping interest rates low for too long in 2006 and not taking activity to rein in the housing market bust by not paying sufficient attention to house price inflation. We have a big bust, and then that eventually impacts on inflation. Then you get a problem with inflation is too low, during the bust. So I don't think that you can narrowly look at inflation in a single-minded way. I think that is far too narrow a view. That by now we should know that it's very important what happens in asset markets. and we're seeing bubbles around. And I think, I totally disagree that the Fed should just look at the United States as a whole, without looking at the rest of the world. The rest of the world learned that the global financial system is very integrated, and an event at a small investment bank in the United States named Lehman Brothers, can have repercussions right through the world in much the same way. If you get an accident in Europe, that's going to have certain reverberations on the United States financial system and on the United States. So the Fed really has to pay close attention to what is happening abroad. Hopefully that they've brought Stanley Fischer in. He will know that what's going on in Japan isn't too good, what's going on in Europe's not too good, that these matters have to be taken into account, when you set your monetary policy.
Charles, what happened to inflation?
Well, I entirely disagree with you, because I think that the central banks are still inflation targeters, absolutely. The point is that the inflation target that you're aiming for is one that's over the medium term. And the error that they're worried about is to allow domestically generated wage price inflation to start going up under the, if you like, coverage of a temporary oil price advantageous supply shock. So you actually start moving much too late. And by the time you're starting to move, it's too late, because you've got a wage price and domestic inflation sort of trend upwards movement, which will really then be quite difficult to hold back. So you've actually got to start dealing with the domestic wage price inflation before it really kills you. The Fed and the Bank of England are, I think, absolutely properly going to look through the purely temporary effects. And if it has temporary effects on expectations, so much is stupider for people invalidly sort of extrapolating short-term developments into the long-term future. No, and I think that central bankers, and here I'm an ex sort of monetary policy committee, and the idea that central bankers have given up an inflation target is just not so.
It sounds to me like what you're saying is basically, when we say 2% inflation, what we mean is that we are not going to be at 2% inflation for a lot of years, because eventually we think we'll get back there.
Yeah. The Bank of England, I think absolutely correctly, was prepared to look through the effect of short-term depreciation of the pound and really quite strong increases in inflation in the years between 2009 and 2012. At various times in the UK, we had inflation rates of 4.5%, 5%, and we said that this was entirely consistent with our medium-term attempts to get inflation back. Now we're running below the 2%. I think we'll run further below the 2%. And again, it'll be entirely consistent to do so. The lags in this whole exercise are such, and the external effects on domestic inflation are such, that you cannot and should not be attempting to hit a 2% level all the time. You're aiming for the medium term, and that is what they're doing, what they're continuing to do. Now, one other thing that I would say, and Desmond is absolutely right to say that there are a lot of dangers in Europe, and that there are dangers that the whole thing could break up in a crisis. It could. But it will be a political crisis, and we probably won't see it coming, and when it comes, it will probably be quite quick, and we can't forecast it. What do you then do? And I don't think that you can adjust monetary policy in advance against the uncertain development of a political crisis. I think that the best, if you like, base case assumption for Europe always has been, and will probably continue to be, that it will muddle on through, and for longer than you think.
Right. If I could just make 2 points, that I would just inject a certain amount of doubt into two basic issues. The one on Europe is one has to be blind not to be able to see the political winds of change blowing through Europe, whether it's Syriza's rise in Greece, whether it's Podemos's rise in Spain, whether it's the National Front in France, whether it's UKIP in the UK, that the move is the political elites are on the run because the economics has been bad. The economics isn't going to improve, so we're really going to get this political rot setting in. I agree with you totally that the breakup of the euro is going to be a political event, but if you look where Europe was 2010, where it is today, the politics has really changed for the worse. That, for instance, just to give you another example, in Italy,
I actually want to steer away from European politics. Fascinating topic though it is. One more question for you guys, and then we'll go to the audience. One more question for you all, which is, Shirley, I want to start with you on this. Communications, clarity. We've talked a lot about this is a fairly, complicated and confusing moment. Is the private sector getting the information it needs from central banks?
I think the central, they all note that, yes, they're getting the communication, but they all second guess it. And I think that's
so they don't believe them.
They don't, well, I think they don't believe the recovery and how strong it will be. And this is what, everyone has their own target. And they have to go from there because, as I said, this is real cost-benefit analysis. They have to make decisions about what to do, how to hedge, if not to hedge, but more importantly, if you should get out of the casino, as I said. And all of this is very much cost-related. The investors, despite the environment, the investors are continuing to demand the same kind of return as they always have. And especially because the US equity markets have rallied so much. And the asset bubble has led them to have benchmarks that are very high. But most of the hedge fund industry, for example, the hedge funds I had polled, including one in Japan, has said that basically you can make returns, modest returns over a few months, and just in this October, over 3 days, it's wiped out. So you do it, you try to be prudent, and then it doesn't work. And when you talk about such short-term losses, does the Fed's communication help at all? No.
Desmond?
I don't think communication's a problem. That I think that it's what you're communicating might be the problem. But that the market knows the Fed has been very transparent. It's been increasingly transparent over time. It lets you know how they think, what they're doing. I think that there've been big improvements on that score. I think where the problem for me is, what the content of the policy is.
Charles?
How do you communicate about the future when you don't know what the future is going to be? And I think that they do very well, really, under the circumstances. But I do think that actually the discussion that Desmond and I were having, how do you adjust monetary policy in advance against the prospects that there could be, but you don't know, political difficulties, particularly in Europe? And I don't know what the answer is.
Well, I think that probably what you've got to be is you've got to be somewhat more humble and stress more the point that your action is going to be very data and very event dependent, and you really don't know. That I think that for you to begin saying, intimating that we're going to begin an interest rate hiking cycle around about the middle of next year, I think that you're really throwing, I'm not sure exactly how the expression goes, hostages to fortune, I guess. That you really are going to have to backtrack, that if the Greek thing plays out the way that it could the next few weeks, it's going to look ridiculous that you said we're going to hike interest rates. But just briefly.
Can I just add to that?
I want to make sure we get some audience questions. So I'm sure they'll be bringing up these issues and we can talk more about them.
I just wanted to say for the third quarter raise, in my poll I asked them specifically, do you believe that the Fed will do, as they say, third quarter, September next year? And 14 of them said no.
14 out of
15 said no. So communication may work, but it's it's in the believers, right?
Right. Questions from the audience? Yeah, in the back there.
So just a clarification, I would actually like to hear a little bit more. I don't think the Fed has said third quarter next year.
Well, no, they haven't said that yet, but the expectation of that.
Okay. The one thing that I did want to ask is many of you talk there's a sense that there's a big bubble out, or even when Binyamin asked the question, he said, so is it time to prick the bubble? And the main concern that I've heard throughout, at least from the two participants, is the equity. And I'd like to get a sense of what your assessment is. If there's an equity bubble burst, what would be happening? Because there was the wisdom, one of the things we said we learned is there are bubbles and there are bubbles. And when the tech bubble burst, because there wasn't much leverage in the system, the outcome was relatively easy to manage compared to the leverage that was behind the house price appreciation. So I'd like a sort of sense of your assessment of leverage in the system and therefore what the implications might be of equity. I think Desmond touched on this when he talked a little bit on the credit market side, but I just wanted to get a little bit more of your views on that.
Yeah, I'm not sure whether or not there's an equity price bubble, that there probably is an equity price bubble by the measures that Shirley's mentioned. I think the problem is more in the credit markets, make absolutely no sense. So if you look at high yield credit or if you look at the European sovereign market, it makes absolutely no sense that countries like Portugal or Italy or Spain are borrowing in the 2-3% range, with those debt levels that they've got. It's just not consistent with the ratings. So you're talking about a tremendous market. If you look at, for instance, like the Italian bond market, that's scary. This is a $2.3 trillion market. It's the third largest bond market on earth, and there's gross mispricing there. So, I don't claim to know exactly what all the other markets are doing, but when I see a market like that there's gross mispricing, I imagine that the mispricing is along the curve, and there's also been a lot of lending on the basis of very optimistic assumptions. You've got to have leverage in the system, and we'll only find this out, once you go through the interest rate cycle. But I think you're certainly going to get it.
Shirley, if the casino closes, how bad is that for the real world?
I think that I agree that Desmond has said also before this panel that he wants to address the credit mispricing. But I think your question was excellent because I wanted to address it. I didn't think I had enough time, which is March 2001, the tech bubble bursting was totally different. And I agree with you. But it's different with two different crises. First, it's different from the housing crisis we had the last time, and it's different from this asset bubble, which is global, because money is coming from every single market. That's very different. And second, it's not focused on housing. Housing is not part of it. It is part of it. In fact, in the last 4 weeks, I was in Israel, Taipei, Shanghai, and back to Hong Kong and then New York. Every single place I see housing bubble. Everything is so overpriced. But I think that I would disagree somewhat. I guess you don't have to call it bubble. We just call it, we use different terms, overvalued. But it's the same to me. Basically, equities now are very expensive, but you don't have anywhere else to go. So what does that mean? There will be more coming in. And you need to go into US dollar-based equities. So that will mean that this will continue to grow. And as I said before, the problem has not ended. I think there's a sense everyone's talking about the Fed is about to change direction as if it's ending. But the fact is most of the private sector actors continue to pour money into it, and they're planning on doing more in order to not be left out of this impossible race.
Anything to add? Over here.
I'd like the panel to talk a little bit about oil and its impact on the long term. Everybody, you included, talk about the short-term impact of low oil. And most of us in this room have been around for 40 years, and the disappearing oil that's been around, oil's always going away, but magically we've got more of it around today than we had supposedly 40 years ago. I guess one is, why does everybody think that oil as a moderately long-term, staying moderately low for a medium-term a period of time is so out of the question? Because everybody, you read the Wall Street Journal, it's always a short-term effect of the low oil. But my question is, could it be a longer-term effect? And if so, what would that mean for the U.S. and the world economy?
Charles, how do you deal with uncertainty about that?
It's a very good point. If you look at the forward rates for oil, and they've barely changed. And about 4 months ago, the forward rate for oil for 4 years hence was between $85 and $90 a barrel. It's still there. I think it's fallen $2 or $3, that the 4-year forward rate. Just fallen, it's hardly fallen at all. And I think that there are two factors. The first one is that the extent of decline is going to cut off really quite a lot of supply. And the shale oil, a lot of it is quite expensive to get at, and the amount of new fracking that will be done in countries like my own will be cut right back, and some of the more expensive oil fields will go down, so supply will go down, and is one of the reasons why the Saudis have done this. And the interesting question, which I can't answer, is whether the knowledge that there is really quite a lot of shale oil out there in the rest of the world, as in Argentina, vaca muerta, the dead cow, and other places, is going to put a lid on it, so that we don't think that it'll ever rise above 100 in the foreseeable future. But in the market, I don't know enough about oil to do anything other than say what the market's expectation of the medium term is. And the market's expectation of the medium term has not changed very much.
Either of you want to add anything?
I just add that I think most Asian players believe that the oil price dropping has two parts to it, the supply and the demand. And I think that the supply part is about, most of the people I talk to think it's 55% of the problem, but the demand decline is about 45% of the problem. So there's two aspects to it. But overall, I think it's good for most of the Asian economies, and it's also good for the US economy to a certain extent. But there are many economies that most funds invest in, Russia, Brazil, that will be hurt by it because they haven't got their house in order. And I think that this will separate those who have figured out the game and those that, like Brazil and Russia, who will be hurt. So there will be medium-term impact that I think most private actors already factored in.
And some of this may shake itself out as we get a better sense of that supply-demand divide, presumably, the factors that are driving this.
Yes.
John.
Sure, I want to ask you to elaborate on China. You've been talking about bubbles. Can you explain to the audience how worried we should be about a bubble bursting in China, in property markets, real estate markets, and I would add one other, manufacturing capacity, where there's been a great deal of investment in the last couple of decades?
I guess the headline, as I would tell you, I know this is being recorded, but I wouldn't worry about it because as long as the government as long as Beijing has their way, nothing will happen. But it is a completely politically controlled agenda, and therefore the housing bubble has been going on for well over a decade. And everybody in Asia is very involved with the real estate market in China. But the Chinese government has spent the last decade trying to bring this down and has been very unsuccessful, including, and this morning I was just explaining to a few people how the market is independent. So unless you are a qualified foreign investor, you cannot invest in the equities or in the housing market. And even if you're Chinese, what has happened is the Chinese government was so worried about the housing bubble that they decided a few years ago, most first-tier city, which is Beijing, Shanghai, those large cities, Tianjin, Guangzhou, and yes, I think I've named them all, you can only buy one apartment per person or per couple. And as a result, this is a very entrepreneurial country. Out of 1.3 billion people, most people who are married got divorced, so they can buy two. And some of the divorce are all because this became a huge social problem. And on top of it, China has a larger issue that sort of relates to this asset bubble, is that demographic change, like Japan, is aging. So productivity is going down, and so that you have asset bubbles rising, but everything else is the growth fundamental is weakening. And so the government has tried to add stamp duty, tax, restriction, and none of it has worked. And finally, it's come to demographics. They now say you can have two children, if you are both single child in a large city. And so that's changed a lot. All of my students are single child. because I teach 21-year-olds. Every single one I've ever taught from China is a single child. And suddenly they're going to be able to have 2. It's a huge change. And part of it is to address the fundamental weakness in this economy that is they know they're going to become Japan. And so both the asset bubble and the weakening economy means the government is very focused. But I think Xi Jinping, unfortunately, despite the fact that we're in an economic conference, Premier Xi is most focused on the anti-corruption campaign right now. But that is a very economically costly campaign. In addition to fighting pollution. All of that is bringing the economy down, worsening the sort of weak economic prospect.
I'm not sure your article matched your headline there. I ended up more worried than I was at the beginning. But there's a question in the back there.
This would be to Charles. You elaborated on central bank controls for the banking industry. What about Dodd-Frank and its provisions? And just as a side, there is a provision in the appropriations bill that's being handled today on the Hill that is creating a lot of stir.
I'm not sufficiently familiar. What is this?
It's the swaps push-out provision.
What does that do?
It removes some of the regulations on derivatives trading that were included in Dodd-Frank.
You're getting too technical for me. I'm not sure that I...
Well, answer the broader question then about Dodd-Frank. How important is that? What's the impact of that?
I think its approach was misguided. I think that the use of public funds, the Troubled Assets Recovery Program, to restore equity in the American banking system was probably the single best thing in terms of policy that's been done in the crisis. And the attempt to shift resolution to bail-in will not work in a systemic crisis. And I think it's made even worse because I understand, though I don't know because I don't know that closely how your system works, that there are attempts to restrict the ability of the Fed to provide liquidity after the event of resolution. All I can say is if that's the case, you're in for a disaster if there is another significant banking crisis in the US. I think the attempt to get a resolution through Title II and the orderly liquidation approach, or the OLA, I think was misguided. I think that it was driven by short-term political hysteria, and I fear that it won't do you any good. And I think in the event, if you do get a crisis, that your system will be sufficiently strong that you'll just override Dodd-Frank and do the right thing anyhow.
Yes, please.
Another question for Charles. Actually, I wanted to get your thoughts on break-even inflation rates in the U.S. and how you square the recent decline with surging stock prices, accelerating job growth, 4.5% GDP growth the last couple quarters, and how you also look at maybe the level versus the change. And in terms of the level is 2%, which is consistent with the Fed's target, and perhaps where it came from at 2.5% to 3% might have reflected maybe too high of an inflation risk premium that might have been related to QE and other unconventional policies.
I'm not sure that I think the break-evens, as measured from the indexed market, the TIPS market, or the index gilts in the UK, are necessarily a very good measure of the expectations that you really want to measure, which, if you like, are businessmen, trades union leaders, and what have you. I also think that they're quite distorted by the need for pension funds to have a matching asset they really in many cases don't have much alternative except to buy indexed at almost any price. And I'm not sure that the resulting measures of break-even are a sensible indication of where medium and longer term inflation is likely to go, and whether it's fundamentally justified. I think that there are a lot of rather specific pressures in that individual market that may be pushing the price the spreads around. But Desmond, do you have a view on this?
My view is that the break-even are not wrong, because basically all they're doing is the same kind of arithmetic that I'm doing, which is if you assume that the dollar appreciates in effective terms by 15%, which is not an unreasonable expectation considering it's already appreciated by more than 10%, and we're going to get more depreciation of the Japanese yen and the euro. That alone gives you something like 0.75 less inflation than you otherwise would have got. If you then add a $40 drop on oil prices, that'll give you about another 1.4 percentage points. So when you add the two of those forces together, you're 2 percentage points below where you otherwise would have been, and where you otherwise would have been is well below 2%. So, to go to zero over the next year, it's not out of the question. It depends whether oil prices stay at 60 and whether we get the depreciation of the yen and the euro continuing. But the headline inflation, the question that Charles raises is, from the Fed's point of view, is the interesting question is, are they going to look through that and say this is a temporary phenomenon, the yen and all of that depreciated, it's going to appreciate next year, we don't have to worry about oil, we're not in a super investment cycle, that oil's going to come back to a high level. But I think that if you just look at the headline inflation the next 12 months, I think, has to be very low.
And Desmond is absolutely right in that. And I thought you were talking about the 5-year break-even. If you're talking about 2-year break-even, Desmond is right. If you're talking about 5-year break-even, then I think that I would expect that the inflation rate to be at 2 or even possibly above.
In the back there. Yeah.
My name is Conley Ricker. My company is Bankers Realty in Virginia, and I appreciate very much this panel, which triggered this question. Also, I'm a former student of Professor Kaplan right there, at which I have to mention his name. Years ago when we had the crash, we had these collateralized mortgage obligations sold around the world. And we had this crisis that was orchestrated by our Fed and our Treasurer with the cooperation and coordination of other financial institutions throughout the world to save the whole financial structure. My question is this financial cooperation and coordination, does it still exist? Or what is your opinion as to whether or not the world's financial institutions are pulling together to solve these problems?
Shirley, you want to start?
Maybe I'll defer to them, but just in my work with setting up a bank in Hong Kong, I find that the cooperation is seamless. I mean, it's much more, no, let me put it this way. Compared to the work I've done 20 years ago, there's increased level of cooperation. I'm not sure the outcome has been successful given the state of the world economy.
Either of you?
Well, I think the way in which they handled the last crisis, does give one encouragement that the next crisis, there'd be similar cooperation. But I don't know how there can be cooperation in anticipation, of the event occurring. They don't even know what the event is that they're going to have to respond to. But, the point that I was trying to make earlier is that the European economy is sufficiently large that if you have an event there, it's going to reverberate right around the world, and it is going to require cooperation of the central banks and the ministries of finance from the major countries to deal with the problem. But the fact that you had good coordination the last time round, gives you hope that they're going to do it again.
Anything to add?
The central banks and ministries of finance are always going to cooperate so long as the cooperation is to the benefit of themselves. But insofar as the idea that one is going to cooperate by taking an action which is not in the benefit of one's own country, for the benefit of the world as a whole, the answer to that one is no. And the idea that the FOMC might take an action that is not in the benefit of the United States because they think that it would benefit the wider world, and it's a figment of people's imagination. The idea that the Eurozone or any central bank of a major country would actually take an action which they do not regard as in their own interests simply because it would benefit the world, that is not the world we live in. Maybe it might be a nicer world if we did, but it ain't.
I think the point that Charles is making is really very important, particularly now with the exchange rate policy, that the Japanese are following a monetary policy deliberately to cheapen the yen. We've already seen the yen move 40%. We're going to see the euro doing something similar. That's the only game that they've got in town to get their currency cheap. But then what it means is there's a problem for the United States. So this can lead to real frictions in the exchange rate side for sure.
And I would just add that I think most Asian players also find this world to be increasingly more mercantilistic, and starting with China, of course, and that they manipulate their currency. And most Chinese companies believe that, see it, and understand. But part of the difference, though, in thinking is that they think the world is on par with what everybody else is trying to do more and more. Even though China was first in doing it, now everyone's catching on as opposed to backing away from it. And the second thing I wanted to add, sensing this panel is ending, is that most of the private actors, actually 10 of the 15 mentioned social inequality being exacerbated by the asset bubble, actually, rather than not worrying about it. They're all very worried that this will cost them actually increased regulation or more problems in the future.
After the crisis, people said that we weren't going to see this type of fragmentation. It turned out we just needed to wait a couple of years to see it. Do we have time for one more, or are we out of time? All right. Well, thank you all very much for coming. I hope you enjoyed it.